Chapter 2. How We Got Here. A Brief History of American Taxation. Part 1 of 2. The story of American taxation begins with a constitutional provision designed to protect slaveholders. What the framers called the Direct Tax Clause, born of the original compromise over slavery, became the legal barrier to taxing accumulated wealth. Tracing how we arrived at this inheritance helps explain why incremental reform keeps stalling and why fundamental redesign deserves serious consideration. The tax code is not the product of a single design session. It is the accumulated result of 2 centuries of legislation, each provision added by someone for someone. The pattern across that history is consistent. Each reform creates new opportunities for avoidance. Each loophole gets exploited, and the system grows more complex while becoming less effective at its stated purpose. The original design, from 1789 to 1913. The founders deliberately avoided direct taxation. The federal government was funded primarily through tariffs, taxes on imported goods, and excise taxes on specific products like whiskey and tobacco. This worked for a small agrarian nation with limited federal responsibilities, but it could not scale. The Constitution's treatment of direct taxes reflects an ugly compromise. Article 1 requires that direct taxes be apportioned among the states according to population. This provision was linked to the 3/5 compromise. Southern states wanted enslaved people counted for congressional representation, and the apportionment requirement was part of the deal. If direct taxes were apportioned by population, states with large enslaved populations would bear higher tax burdens, theoretically offsetting their increased representation. The federal government's first attempt at income taxation came during the Civil War. The Revenue Act of 1861 imposed a flat 3% tax on incomes over $800. By 1865, the rates had risen to 10% on incomes over $10,000. The tax was administratively successful, raising significant revenue for the Union war effort. After the war ended, it was gradually phased out and repealed entirely in 1872. The Civil War income tax proved something important. Income taxation was administratively possible. The federal government could identify taxpayers, assess their incomes, and collect what was owed. The question was whether it was constitutional. In 1894, Congress passed a new income tax, a 2% tax on incomes over $4,000. The following year, the Supreme Court struck it down in Pollock versus Farmers Loan and Trust Company. The court ruled that taxes on income from property were direct taxes, requiring apportionment by state population. Since apportionment was unworkable for an income tax, meaning it would require different rates in different states based on population rather than income, the decision effectively prohibited federal income taxation. Justice John Marshall Harlan dissented vigorously, warning that the decision would make it impossible to tax accumulated wealth. He was right, until the Constitution was changed. The Income Tax Amendment of 1913. The Pollock decision created a constitutional crisis. But the years that followed were not spent building support for an amendment. They were spent trying to work around the court's ruling, hoping the problem would solve itself. Once reformers committed to the amendment path, momentum built quickly. Progressive-era reformers, populists, and labor unions organized. The campaign built pressure state by state. Legislatures passed resolutions calling for an amendment. Politicians who opposed it faced electoral consequences. By 1909, the political moment had arrived. President William Howard Taft, a Republican, supported the amendment. Congress proposed it with near unanimous votes, 77-0 in the Senate and 318-14 in the House. When the political will was clear, the constitutional barrier fell. Ratification took less than 4 years. 42 states ratified, well above the 36 required. The 16th Amendment became law on February 3, 1913. It reads as follows. The Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. The original income tax was modest by today's standards. It imposed a 1% tax on incomes over $3,000, equivalent to roughly $98,000 today. Rates graduated up to 7% on incomes over $500,000. Only about 2% of the population paid any income tax at all. The original intent was clear: tax the wealthy, spare the workers. The income tax was designed as a levy on accumulating capital wealth, not on wages. It took decades for that intent to be inverted. The 16th Amendment did not emerge from nowhere. It was the culmination of a tradition that runs through American politics like a fault line. Henry George's book, Progress and Poverty, published in 1879, argued that the fruits of civilization belong to the civilization that produced them. It sold 3 million copies in a country of 60 million. The populist movement of the 1890s organized farmers and workers around the same principle: that concentrated wealth owed a duty to the Commonwealth. The progressive reformers who pushed the amendment through Congress were heirs to that tradition, not its inventors. The idea that wealth should be visible and accountable is not new. It is unfinished. The lesson for today is worth noting. Constitutional barriers to taxation can be overcome, and faster than most people expect. Once Congress proposed the amendment, ratification took less than 4 years. It takes organization, sustained advocacy, and political will. But when the moment arrives, change happens fast. The growth of complexity. From 1913 to 1980. The income tax started simple. It did not stay that way. World War I transformed the tax system. Rates rose dramatically to fund the war effort, and the top marginal rate reached 77% by 1918. More importantly, the tax base expanded. Exemptions were lowered, bringing more Americans into the system, and the first major deductions and exemptions were created, planting the seeds of future complexity. The 1920s brought rollback. Top rates were cut to 25%. Wealth concentrated rapidly during the Roaring Twenties. The crash of 1929 and the Great Depression followed, a pattern that would repeat. The New Deal and World War II transformed the income tax into a mass levy. Top rates rose to 94% by 1944. More significantly, withholding was introduced in 1943. For the first time, taxes were deducted from paychecks before workers ever saw the money. This was administratively efficient, and it created a fundamental asymmetry. Workers paid immediately and automatically. The wealthy, whose income came from investments rather than wages, retained control over when and whether to realize taxable income. The post-war period saw an explosion of complexity. Each new provision in the tax code created new avoidance strategies. Tax lawyers and accountants became essential for anyone with significant wealth. The code grew from a few dozen pages to thousands, then tens of thousands. A cycle established itself. Reform, capture, new loopholes. Congress would pass legislation to close one avenue of avoidance, and the tax planning industry would find 3 more. Complexity became a feature of the system itself. By 1980, the tax code was already labyrinthine. But the most consequential changes were still ahead. This is an excerpt from The Last Tax by Dan Schaefer, available now in paperback, hardcover, ebook, and audiobook. Links are in the description. Subscribe for more as they become available.